New price target. Julian is Evercore ISI's Senior Managing Director. Julian, great to have you with us.
Great to be here.
So the warning is beware January, because it's not going to be a straight line higher.
So I wouldn't call this irrational exuberance, but we've seen there are pockets of exuberance. The Conference Board survey actually showed the highest reading ever of people that think stock prices are going to be higher a year from now. That's the kind of cautionary, and just for reference, the formerly highest reading was the beginning of 2018, and there's been a lot of discussion of 2018. And when you think about the policy backdrop of the incoming Trump administration, it's pretty easy to make the case that we're going to get a little bit of volatility to start the year.
That is exactly what Lori was talking about, 2018 being the comparison year. What's your price target, Lori?
So we're at 6,600. We also have a bear case of 57.75, and it's interesting. There's as much interest in my bear case as there is my target, just because I do think there is a lot of nervousness about sentiment. There's a lot of nervousness about valuation, but that runs counter, to the strong animal spirits, economic upgrades that we're seeing.
So I would just say, and this is a positive, that clients are very, very focused and very concerned about valuation. And as all of us sit around here, I dare say we have been nervous about valuation, all of us, probably for the last 6 months. Valuation alone doesn't end the bull market, but what it does is it makes it susceptible to any sort of less than perfect news, which, the amount of geopolitics that we have going on. And what happens if someone says, Fed Chair Powell, do you think there's any scenario in which you might hike interest rates next year? How that question gets answered on Wednesday is going to be pretty informative.
Dan?
Yeah, so we have the fateful 8 here now. Broadcom just add this thing. It's trending. Does it worry you a little bit that those 8 stocks are about 20% of the S&P 500? I know we've been talking about concentration, but if you're talking about valuation, they're also a really important component of the S&P 500 valuation. We've seen massive multiple expansion. They're about 40% of the S&P 500. So 20 trillion, 8 stocks, 40% of the S&P 500 that are making up a lot of the expected growth in the index next year.
It's definitely a concern, and we all know there's one stock in particular that's had an incredible run-up since the election and is now trading over 200 times earnings, and I dare say that that's a consideration and a worry no matter what. But again, it's one of these things where if you think about it, I think we were all amazed when, say, the top 5 stocks in the weighting in the S&P 500 rose beyond the Y2K peak. And think about how long ago and how many index points ago that was. Again, it's a question of you need other things. And it's in our mind, it's going to be, potentially irrational exuberance. We think the capital markets will show the way towards that if we get there, or a recession, which we just don't see in 2025.
So U.S. exceptionalism has been the story for years now. Dollar at some point is a problem. Rates at some point could be a problem, but haven't really been so far. What do you think about the rest of the world? We know their politics in Europe are kind of scary right now, but it's been a lot of underperformance.
We are getting a ton of questions about the rest of the world. It started about really right at the election, because the assumption is in an America First president, you'd see more of this kind of performance, which you have seen. From our point of view, again, here, valuation relative or absolute, it's very difficult to just make the case that it's going to work on the basis of that. We would want to see, in Europe, a reasonably defined dollar top, which is something to certainly look out for. That may be driven by Trump's displeasure. You remember he got uncomfortable about the strong dollar during the first administration. In China, we'd really want to see bond yields stop declining. It looks very much like what you saw in Japan in the 1990s in terms of yields going lower than you could ever imagine. And then as far as Japan, what we want to see is sort of a separation between the way the Nikkei trades and the way the yen trades. And we think that's possible. It worked throughout the 1980s. But again, all of these are catalysts that we're waiting for the macro backdrop to change. And we do anticipate, getting more positive on the rest of the world at some point.
Super quick, Julian, you like small caps? Do you expect small caps to outperform S&P broadly next year?
We do.
Okay.
We do. It's really, if you look at the year after every election since 2012, you had this spike in small business uncertainty. It comes off, and small caps have worked throughout those cycles.